Greetings and welcome to CCIM Institute's webinar on new lease accounting standards. Before we get started, if you are using a phone line, please take a moment to place your phone on mute. Unmuted phones cause audio disruptions for others who are dialed into the session. Additionally, please submit any questions you have through the chat feature located in the bottom left-hand corner of your screen, and we will respond to them at the end of the webinar. Today's webinar, New Lease Accounting Standards, features Angela Newell and Richard Juge. Angela is a national assurance partner in BDO's Dallas office and has 20 years of experience in both auditing and operational and financial reporting. At BDO, Angela plays a key role in the accounting firm's response to the new revenue recognition and leasing standards. Richard is a broker-owner of 2 RE/MAX commercial offices in Southeast Louisiana and works exclusively in the commercial real estate industry. Richard holds the CCIM and SIOR designations and is very active in CCIM in the role of senior instructor. His past involvement includes CCIM Institute president in 2010, roles on many CCIM committees, and leadership roles in the CCIM Louisiana chapter. Angela and Richard will walk you through an overview of lease accounting standards from the commercial real estate perspective, lease reporting treatment, top challenges companies need to address, and considerations for lease and buy processes and strategies. Richard, please continue with today's webinar.
Thanks, Jen. Welcome, everybody. Hopefully you can hear me well. This is an exciting time for us as practitioners in the business, and I always say that we have a term in when we go to write our course materials, we call them SMEs or subject matter experts, and oftentimes we'll reach outside of our own to get to somebody like Angela. And Angela, by the way, your company has to have one of the catchiest phrases in ads these days for the, what is it that people who know BDO, is that right?
That's right.
So glad to have her here. Let me just set this up, guys, for all that are in attendance. If you've taken the CCIM courses in the last, I'll say 8 or 9 years, thereabouts, we've had accounting sort of rules, I'll call it, in the 103 course for the most part. And we've recently rewritten and re-updated this for this subject that's actually at hand today. So as we're launching off a webinar today, we'll have this in our materials going forward starting next year. So whether you've taken the classes, I'll say in the last 7 or 8 years, there's going to be some new updated information, especially in the old Module 4. And for the rest of you that haven't taken a course, obviously as you peck your way through the order of 101, 102, and when you get to 103, some of this information will be in there. And Angela, not to put you on the spot, but a lot of what we also have changed in here is talk about EBITDA and ratios and things like that. And we're trying to make this as real world and applicable as we can. So
sure.
I'll just kind of set up that this topic is very much in our material, but also is worthy of 45 minutes or an hour, which we're going to do here today for all of you in attendance. So thanks for taking the time out of your day, everyone who's listening. And Angela, thank you very, very much for the work that you put into this so far. And I'll turn it over to you. And if we have questions as we go along, if you guys would chat them in the bottom left, and occasionally I might chime in myself. But Angela, it's all yours.
All right. Thanks so much, Richard. I'm excited to be here with this group today. Let's get started. You see hopefully a graphic that says, has your company started to assess the impact of the new leases standard? I know that most of our audience today are lessors, or that's my understanding, commercial lessors primarily. And so I suspect that that you've probably at least started thinking about it, you've heard about it, and wondering really will it impact you. And so that's our goal today, is really to talk about how will it impact commercial lessors, but I will also give you an overview of how it will impact lessees, primarily just to help you understand what it is that your clients will be addressing and facing, and to help maybe allow you to think about what kinds of questions they may come to you with, or requests for changes as we move forward with new lease negotiations. So with that, let's dig into the session, to the topic at hand. The FASB, the Financial Accounting Standards Board, which is our accounting standards setter here in the U.S., issued the new leases standard in February of 2016. So it's almost 2 years old at this point. The new leasing standard, really the FASB had a stated goal to put leases on the balance sheet. So they did retain what's considered a dual approach for lessees and lessors, which means we still have the old operating versus capital lease classification, although now we call it operating and finance leases instead of capital leases. But operating leases are being put on the balance sheet for lessees. The good news for lessors is that your basic model didn't change significantly, although there are some areas of change that we'll address later. But the majority of the changes under the new standard really are on the lessee side of the house. The new standard is effective for public companies in 2019 and for private companies a year later, beginning 1/1/20. So we still have a little bit of time to get our arms around this. All right, so the new model for lessees is, I mentioned, everything goes on the balance sheet. And the vehicle or the way that everything goes on the balance sheet is that the new concept is that there is a right of use asset, an ROU, that represents the value of the lessee's right to use the leased asset. And by the same token, there is a lease liability that will go on the balance sheet. There is one exemption or exception for leases whose terms are less than 12 months. For commercial real estate, we'll be surprised if you have any of those, but for some of our equipment lessors, that is something that their lessees are exploring. Again, I mentioned that we are still going to continue to classify all leases as either finance or operating. The main differentiating factor is whether or not the lessee effectively controls the underlying asset or not. And again, we have a similar balance sheet impact between finance and operating leases, but as you'll see in a future slide, that there is a difference in the income statement and cash flow presentation, just like there is today between operating and finance leases. And we think that that difference on the income statement may actually start to drive behavior by lessees in a slightly different direction than it has been historically. All right, so while continuing down the lessee accounting route, I mentioned a right of use asset and a lease liability. The balances that go on the balance sheet, they are a present valued balance, and so the first thing that a lessee will do is they'll value that lease liability. The lease liability is just the present value of all future lease payments. And you'll see here in the subsequent measurement box that that's going to continue going forward. So at each reporting period, the balance or the amount of that lease liability that a lessee will show on their books is intended to be the present value of all future remaining lease payments. At lease inception, the lessee calculates that lease liability. They put that on their books, and the offset to that entry is the right of use asset. And so when you're deciding what the value of that right of use asset is, the starting point is the lease liability, again, that present value of future lease payment, and then it gets adjusted. And so we're going to add to that right of use asset any initial direct costs that the lessee is able to capitalize, and we'll actually subtract from that any lease incentives that the lessor provides for the lessee. The subsequent measurement of that right of use asset will be at amortized cost, and we'll see on the next slide that, or in a future slide, how that income statement impact is presented. All right, so I mentioned that for lessees, all leases will go on the balance sheet. They are presented either separately as a separate line item if they're material, or within similar classes of assets and liabilities if not. And as you might imagine, this is a fairly significant change for most lessees. One commercial lease, for example, for a headquarters facility, a couple of floors on a commercial building, the present value of those future lease payments can be very significant to that lessee's balance sheet. And so as you might imagine, lessees are highly aware of this new standard, and it is going to make a significant difference to their balance sheet ratios. The income statement, on the other hand, is not going to change under the new standard. So for finance leases, what you'll see on a lessee's income statement is amortization of the right of use asset, just like you see an amortization of a capital lease today. and you'll see interest expense on the lease liability. Again, similar to the way you see interest expense on a capital lease liability today. And by the same token, operating leases, the interest component and amortization component just get put together in one amount that goes into operating expense, just like rent expense today. In fact, a lessee can choose to continue reporting that one amount as rent expense in the future if they so choose. But the interesting thing I think that's important to point out here is that given the income statement dichotomy, and in particular many lessees focus on EBITDA as one of their primary metrics, the fact that a capital lease treatment is really preferential from an EBITDA perspective, because you're reporting interest and depreciation, which are two of the items that get removed from income to arrive at EBITDA, as compared to an operating lease whose expense sits in operating expense and that's in EBITDA. We think that may drive some lessees that enter into longer-term leases today, which may be the case for many of you with commercial real estate. Many of those lessees may change their lease negotiation strategies. Today, most companies negotiate their leases in an attempt to avoid capital lease treatment because they don't want those leases on their balance sheet. But going forward, if all leases are already on the balance sheet, then it may be beneficial to those lessees to negotiate even longer lease terms and that result in finance lease treatment so that they get that preferential income statement treatment. So just one thing to keep in mind as you think about for future negotiations with your lessees.
So, Angela, this is Richard. Did I hear you correct on maybe starting with the balance sheet here? If currently I own real estate, it shows up on the balance sheet as an asset. If there's no debt, does it show up as a liability?
No, but if you own a building today and you have no debt, there's no liability associated with it.
But isn't potentially one benefit here that there is a residual value, presumably, to the real estate, assuming you don't just give it away at the end, that if we start to maybe think about a lease versus own decision, might it be that companies just say, well, heck, if it's going to be on the balance sheet, why don't I just own it?
That's absolutely a good point, Richard. Certainly companies that have healthy cash flow and low borrowing rates that could borrow the cash to pay up front, or they have the cash available to pay up front to buy the building, that absolutely may be one of their decision points. Obviously, many companies either don't have that cash flow available, which is why leasing is another reason why leasing is attractive to them, and in other situations, the company just doesn't want the legal and regulatory risk associated with owning the building for whatever reason, so leasing may continue to be attractive to them. But you're right, if all of the leases are going on the balance sheet, that may tip a lessee that was on the edge to begin with into a buy decision.
Great, thanks.
Mm-hmm. All right, and this slide just reiterates that from a cash flow statement perspective, under the new standard, the lessee presentation will look basically the same as it has historically. So let's switch gears for a minute and talk about lessor accounting and what that's going to look like. I mentioned that the new standard doesn't really make a lot of changes to the lessor model, at least not the basic model. You will still classify leases as either sales type, direct finance, or operating. I'm not sure if anyone on the call uses leveraged leases. That's a tax play. If you do, know that leveraged lease treatment is grandfathered. So if you have existing leveraged leases, you will continue to account for them as leveraged leases until they either end or are modified. But any new leases that you enter into, or if you modify an existing lease, that leveraged lease treatment is no longer available under the new standard. For sales type lease, a direct financing lease, and operating lease, the subsequent accounting is pretty consistent with current GAAP. The definition of how you determine whether something is a sales type versus a direct financing lease changes slightly under the new standard, but by and large, that overall model really is consistent. So let's look at the accounting for each type of lease under the new standard. For sales type leases, just like today, the underlying asset is derecognized. That goes off your books as if you had sold it. And what you put on the books is your net investment in the lease. That's the present value of the future lease payments plus any unguaranteed residual assets. To the extent you've got selling profit or loss, then you do recognize that at the time that the lease is entered into, or at least at the time that it commences. And you do expense any initial direct costs. Again, that's consistent with today's presentation. Subsequently, the net investment is reduced by payments received, net of interest and accretion, assessed for impairment like normal. And if you do have variable lease payments, those are accounted for as they are earned. Direct financing lease is consistent. Again, the underlying asset is derecognized and the net investment in the lease is put on the books. The difference, just like today, between a sales-type lease and direct financing lease is the recognition or non-recognition of any selling profit. So with the direct financing lease, that deferred selling profit continues to be deferred as opposed to being recognized up front. And with operating leases, again, just like today, you will continue to recognize the underlying asset. Any initial direct costs that are capitalized will be expensed over the lease term on a straight line basis, just like lease income. The underlying asset is tested for impairment under the asset standards, and lease income is recognized on a straight line basis. Again, this is all consistent with today's guidance. One thing I will point out, in an earlier version of the standard, as part of the proposal process, at one point the FASB did recommend eliminating that operating lease treatment and having lessors actually derecognize a portion of an asset. Thankfully, cooler heads prevailed, and they realized that just didn't make a lot of sense practically. So we are back to what is currently practice remaining in the new standard relating to operating leases. So that's good news.
And Angela, this is Richard again. What is the sort of grandfathering of these various lease types, I guess, for both lessees and lessors? But if I signed a 6 or 7 year lease before and it was classified as an operating lease, do I have to change that now and convert it to a finance lease?
Yeah, that's a great question, Richard. There are various practical expedients associated with transition, and we'll look at that just briefly on a future slide. But the short answer is that companies can elect not to reassess classification. So you can elect as part of the implementation to just say, whatever my classification was, as long as that was appropriate under the old GAAP, I can leave that. I won't reassess. Companies do have the option, if they choose to go back and actually do a full reassessment. But so far, every company that I've spoken with has indicated that they plan to elect those practical expedients and not have to do that reassessment.
Great, thanks.
Mm-hmm. All right, so I mentioned that by and large that the lessor model is staying the same. So while there are changes around the edges that may impact things like equipment leases and leases that are more specialized in nature, things like power plant leases, etc. For commercial real estate, generally the definition of the lease won't change. The identification of lease term and lease payments aren't expected to change. The lease classification test is very similar, although the bright lines go away. For anyone on the call that took Accounting 101 in college, you probably the only thing you remember from that class are the 75% test and the 90% test on the lease classification test. Those tests in and of themselves are still in the new standard. The difference is that those percentages go away. And so, for example, instead of saying that if the lease term is 75% or more of the remaining economic life of the underlying asset, you have a capital lease. Now the standard says that if the lease term is for the major part of the remaining economic life, then you have a finance lease. And by the same token, instead of lease payments being 90% or more of the fair value, you now have lease payments that are substantially all of the fair value. And so the concepts and the intention there is the same, and which is why I say the lease classification test likely won't change. Just know that it's a little bit more flexible. There aren't those hard, bright lines. And the last point here is that today there is a requirement to separate lease and non-lease components. So, for example, if you've got a contract to manage a building on behalf of a lessee, that's a separate arrangement from the lease itself, and there is a requirement to separate that. That doesn't change in the new standard.
So, Angela, on the lease classifications, and we have historically taught this in our 103 material under the capital lease heading, and we did those 75% in the 90% tests. On the one that was the 75%, and still is, I guess, of the economic life, we teach also in our courses the depreciation life given to us by the IRS of 39 years in commercial and 27.5 years in residential. But were those terms necessarily synonymous in the economic life of an asset, especially real estate?
That's a great question, Richard. I think generally the answer is yes, although there's not a one-for-one. Obviously, the tax lives are set by the IRS, and so they're not exactly the same. I think most companies under U.S. GAAP assume for a new commercial building, or really a building in general, a general purpose building, that 40 years is a reasonable useful life. Obviously, the question where it becomes much trickier is when you're entering into a lease associated with a building that's not brand new, right? And so then the question is, well, what is the remaining useful life at that point? And especially as you get into older buildings that have been through renovations and all of that. But the short answer is yes, generally 40 years is a reasonable, useful life for a new building, and that's consistent with, to your point, the IRS life.
And I'm going to have one more question that hopefully I'm not stumping you here, but I've seen in the tax plans, and I know this is yet to be worked out or even passed, but I see where they're potentially changing the depreciation to 25 years. So I'm wondering what the follow-up or the balance will be with the accounting world, if that goes.
Right. I think the short answer is there won't be one. The accounting life is, in theory, supposed to represent a true economic useful life, and so it is somewhat. The fact that the 40-year life used for GAAP is similar to the tax life, I think, is driven by the fact that the IRS originally picked a life that was close to the GAAP life rather than the opposite. And so if the IRS changes that's not really going to change the accounting. No different than if you elect for equipment and that kind of thing, bonus depreciation today, it doesn't change the period you depreciate over for GAAP.
Got it. Well, I don't know if you're an IRS tax life expert, but if they change that, we'll have to have you on in about a month, I guess.
That is definitely not my area of expertise. I try to stay away from the tax rules. All right. Well, that's what's staying the same. And like I said, that is the broad strokes of the model. But let's talk about what is changing. I mentioned that we do still have to separate or segregate non-lease components from lease components. I think the important thing to point out there is that oftentimes what we're finding in practice is that both lessees and lessors have not historically thought a whole lot about that separation, primarily because the accounting for the lease was not significantly different than accounting for the service component. Both were pretty much straight line rent expense as you go. Now, though, however, given the need to put, or the requirement to put the lease on the balance sheet for lessees, that distinction has become much more critical. And even for lessors, although it doesn't change your balance sheet presentation, there is a presentation and disclosure difference between the service contract that is accounted for under the new revenue standard, ASC 606, and the lease component that's accounted for under the new lease standard, ASC 842. And I'll mention disclosures on a later slide. You'll see the difference. The new standard specifically indicates, and this is a big change, that CAM, common area maintenance, is no longer considered an executory cost, that it is considered a service component that would be accounted for under ASC 606. Now, you'll notice on here that the lessees can elect a practical expedient to continue to combine service components and lease components. It just makes their balance sheet bigger. But lessors today, under the standard, do not have that election, and this is one of the things that many of our commercial real estate lessors are unhappy about, is this need to separate the two. Now, the FASB did have a board meeting about 2 weeks ago now, and one of the things they considered at that board meeting was whether or not to grant a similar practical expedient to lessors to make their lives easier. The FASB did vote to extend that practical expedient to lessors, So this is sort of late breaking news. I'd encourage you to kind of continue to watch this space, that assuming that this rule does go ahead as the FASB indicated on their if they're meeting 2 weeks ago, then in early to late January we should see some relief on that front. One of the other big changes are in initial direct costs. I think today the definition of initial direct costs under the lease standard is fairly broad. Many companies capitalize quite a few different costs. It could be commissions paid, it could be internal costs to review a lease, to set up a lease in the system. Any of those types of costs, however, going forward, with the exception of broker fees and other commissions, will no longer be able to be capitalized under the new standard. So initial direct costs are defined narrowly under the new standard. They only include costs that are dependent upon a lease being executed. So the way I usually explain that is, if the lessee were to walk away at the very last minute, if you would have incurred that cost, even if the lessee walks away, then it can't be capitalized under the new standard. And so a good example of the distinction are legal fees to review the lease and review the negotiation process. Those would have been incurred regardless of whether you actually signed the lease or not. And so therefore those are not incremental. They're not dependent upon the lease being executed, and thus they're no longer capitalizable under the new standard. On the other hand, a broker commission that's only paid if the lessee actually executes the lease, that is dependent on the lease being executed, and it can be capitalized. A couple of other things that change. Sale-leaseback accounting and build-to-suit lease accounting historically have been very complicated areas of the leasing standard, and quite frankly areas with commercial real estate that take a lot of our lessees by surprise. They don't realize when they do a sale-leaseback that the requirements are fairly stringent under current GAAP to achieve sales accounting, and they're even less aware that if they play a role in that build-to-suit period, and if they have take on the risk of that construction project, then they may be deemed the owner during construction. The good news is that under the new standard, both of those rules are relaxed somewhat. The new standard really relies heavily on the new revenue standard and its definition of control to decide whether or not a sale has occurred for accounting purposes with sale-leaseback, and to determine whether or not the lessee controls the project during construction for build-to-suit leases. So that's the good news, but as you see in the red box at the bottom of the slide, the bad news is that these provisions are now applicable to lessors. They've never been applicable to lessors before. And you may ask yourself, what does that mean, that it's applicable to lessors? Let's take the example of a sale-leaseback. So for example, if a commercial lessor purchases a building from an owner-occupier and then turns around and leases it back to that owner, the question of whether or not that owner achieves sales accounting and therefore gets to de-recognize the building and recognize the lease right of use asset and liability actually impacts the lessor as well. So if it's deemed that the control criteria in ASC 606 are not met, what that in essence means is that the lessor would not recognize that building on their books. Instead, any cash that they paid, the payment paid for that building, would go on their books as in essence a receivable. And so I think that's a pretty significant change. Again, it's less likely that you get caught in that trap, but it does become important for lessors to understand that accounting because it could be applicable to them.
So, Angela, this is Richard. On the sale-leaseback in particular, what defines control? How do you, in one sense, if it's a triple net lease or an absolute net lease and the tenant is paying for everything and basically maintaining it all themselves, is that not what's considered control, or how do you define that?
Yeah, no, that's a great question, Richard. Thank you. So under ASC 606, there are either 5 or 6 indicators of control. And it really looks at who controls the building at day one. So a few of the indicators are, do you have physical possession of the building? Who has legal title to the building? Whether or not payment is due? Which entity has all the risk and rewards of ownership? And so if you think about it from the lessee's perspective, because you're not assessing who controls during the leaseback period, you're assessing the control for the purposes of the sale. And so because of the existence of the leaseback, the lessee is always going to fail the criteria of physical possession, because the buyer, in this case, the lessor, won't take possession of the building. It will remain with the lessee because of the leaseback. And so that puts pressure on some of the other indicators. So obviously, on the other hand, the lessor will always meet the criteria for legal title transfer, right? That's just part of the sale process. And so there are a few of those control indicators that go one way or the other. And so really, I think it's going to boil down in many cases to who really has the risk and rewards of ownership. And so, for example, in ASC 606, one of the things that it states is that if there is a purchase option, a repurchase option in this case, then sales accounting is not achieved because the buyer doesn't have all of the risk and rewards of ownership. So we think that's one of the areas that's going to be critical in determining whether or not both parties achieve sales accounting in this case, is if that leaseback has a right of repurchase in it. There are other things that might cause that to fail, cause the parties to fail sales accounting, but that's a key one.
Great, thanks.
Mm-hmm. All right, I mentioned earlier disclosure. So this is another significant change on both the lessee and the lessor side of the house. So there's a significant number of new disclosures in place. On the lessee side, historically, and really for both lessees and lessors, the only disclosures that have really been required under the current guidance are the 5-year maturity tables, right? Under the new standard, those disclosures are expanded significantly. So, for example, lessees are going to be required to disclose contractual details, things like lease term, contingent rentals, you have percent rent, those kinds of things, renewal options, and any related accounting judgments. One of the key components, I think, for lessees is that they're now going to have to disclose information about any significant leases that haven't yet commenced. So as we all know, when we're talking commercial real estate, there may be a gap of anywhere from 3 months to a year or more between when the lease is actually executed and when it actually commences, in particular if there are a significant leasehold improvement build-out happening. And so there's a requirement to the extent those leases that haven't yet commenced are significant, that the lessee will have to disclose that information. You'll notice on the next bullet, this is the 5-year maturity table. It doesn't actually have to be in a tabular format for lessees, although we'll see in the next slide, lessors do have to maintain that tabular format. But in addition to the maturity analysis, lessees will also disclose the weighted average remaining lease term, weighted average discount rate, and information about cash flow and non-cash information. Also information about the income statement impact, and if they've elected any of the practical expedients, then they're going to need to disclose that fact and related details. So as you think about your terms, to the extent you've got a lessee who has 1 or 2 leases that are really significant, while there's obviously no requirement to disclose the counterparties or anything that's competitively detrimental, they are going to be disclosing a lot more information about the terms of their leases. And really that's the same thing for lessors. Lessors are going to be required to disclose contractual details again, any related accounting judgments, a narrative disclosure about the leases, including information about variable lease payments, again, any kind of percent rent, rent that's based on some sort of an index, CPI increases, that type of thing. Any of that rent that's variable will be disclosed, renewal options, termination options, purchase options, those types of options, all disclosed. And then I mentioned continue to present a tabular presentation of profit or loss at commencement, interest income on receivables, lease income for operating leases, and then the 5-year maturity analysis. And again, for me, is one of the most critical new disclosures for lessors to keep in mind is this narrative disclosure about risk management for residual assets. So you might remember on a previous slide, I mentioned that for sales type leases and direct financing leases, the way you determine the amount that gets put on your balance sheet, when you de-recognize the underlying asset, you recognize the present value of the future lease payments plus the expected residual value of the asset. So obviously, when you've got, especially if you've got a longer term lease, 10, 15, 20 years out, predicting what that residual value is going to be is judgmental, right? There's a lot of estimation involved in that. And so one of the disclosures that the FASB is requiring is, how do you come up with those residual values? And what is your risk management associated with managing the risk that that value may be different at the end of the lease term? One thing to point out, these disclosure requirements are required for all lessors, not just public companies, that there's not a distinction here between public and private. So that's another important thing to think about, is that even private lessors will need to think about these disclosures. All right, so that's an overview of the standard and generally what's changing, what's not changing. So what's the impact? Got a couple of examples here. So as you're probably aware, public companies have a requirement that we were lovingly referred to as SAB 74 after the rule promulgated by the SEC that requires them to disclose what pending new accounting standards, what the impact of those new accounting standards will be to the company. And so I picked Starbucks just because they're obviously a very large lessee. They have literally tens of thousands of leases across the country and internationally. And so you'll see the first part of their disclosure. This is from their most recent 10K. Starbucks is a non-calendar year-end company, so this is their most recent filing that's out there. The part in black is just an overview or a summary of the standard itself. The part in red is what they are talking about the impact will be. So you'll notice that they're still evaluating the impact, but that they do expect the adoption to result in a material increase in the assets and liabilities, and likely to have an insignificant impact on their statement of earnings. So again, this is consistent with what we talked about earlier, that there's going to be a significant material impact to most lessees' balance sheets, but really not a significant impact to their income statement. The other thing that they note is that in preparation for adoption, that they're in the process of implementing controls and key system changes to enable the preparation of financial information. We'll look at some thoughts around next steps on a couple of slides later. I think one of the key takeaways for lessees in particular, but possibly also lessors, is that because of the balance sheet impact for lessees in particular, many of our lessees are having to perform system implementations just to be able to track the leases and really do the accounting. Alternatively, here's an example from a large corporate commercial realtor lessor, SL Green Realty Corp. Again, this is their most recent filing that's available out there. The black, again, is a summary of the standard. The part in red is what they think the impact is going to be to them. You'll notice that they mention this presentation and disclosure of non-lease components. I will tell you that they filed this financial statement. They issued this statement prior to the FASB meeting the other day that I mentioned, which may provide or expected to provide relief in this area. So we're not sure whether many lessors will take that practical expedient that we expect the FASB to issue or to offer. I suspect many will, but we're not sure on this company in particular whether that will change. But at this point, they've indicated that's a key issue. And then, of course, from their standpoint, they're not only a lessor, but they're also a lessee, because in many cases, they actually lease the ground on which their buildings are built. And so from their standpoint, they also have to apply lessee accounting, which will mean recognition on the balance sheet, just like our lessors. So again, for commercial lessors who actually are leasing the underlying ground, don't forget that you may have to apply the lessee components of this standard as well. All right, so let's talk transition. For both entities, the standard has one required transition method. It's called modified retrospective. And what that means is that, for example, if you are a public company with a calendar year end, you're required to adopt the new standard as of 1/1/19. In public company financials, as you're probably aware, the SEC requires a presentation of 3 years of income statement So under a modified retrospective approach, the company would show a cumulative effective adjustment as of 1/1/17, and they would restate their 2017 and 18 periods presented, and then have 2019 on the new standard. Now, it's important to note, you'll see on here, as part of that meeting 2 weeks ago, the FASB also voted to offer a second transition model that companies can elect, and so we expect to see this in mid-January, this become available. And that practical expedient would be to not actually restate the 17 and 18 years in my example, but to present the cumulative effect adjustment as of 1/1/19, or the year of adoption. So again, watch this space. This is late-breaking news that hopefully will provide some relief to companies that will be adopting. Even absent that, though, if you do choose, or if you're required to do the full modified retrospective, there are significant relief provisions allowed as a policy election. I mentioned one of them earlier to Richard's question about the classification. So you'll notice here, there's if you elect this package of practical expedients, you can choose not to go back and reassess whether or not you have a lease. We talked earlier that for commercial real estate, that lease classification probably won't change, but for other leases, there might be some change. But so with this policy election, you can choose not to reassess whether or not you have a lease. You would not go back and reassess classification between, again, operating versus capital leases or finance leases under the new parlance. And the good news is that if you elect this package of practical expedients, you don't have to go back and reassess your initial direct costs. So anything you capitalize under your current policy would continue to stay on your books and continue to be amortized over the rest of the period. And I mentioned earlier that they did grandfather in leverage lease treatment. On the sell-leaseback, there are some specific transition guidance for that. Again, there's no need to go back and reassess. So from a lessee's perspective, if they achieved sales accounting to begin with, they don't have to go back and reassess that. But they do go back and reassess if they failed sales accounting. Because 9 times out of 10, the thought is that under the new standard, they probably would get sales accounting. So again, from a lessor's perspective, you can elect this practical expedient and not have to go back and reassess whether or not any of your existing leases might have been sell-leasebacks. That's really only applicable going forward. So that's helpful. Again, not really relevant to the lessor side, but it is important to know that for lessees that historically did achieve sales accounting, they were required to defer any gains on that sale-leaseback. Oftentimes, obviously the fair value is more than the carrying value at historical cost the lessee had, and so they have this built-in gain when they do a sale-leaseback. Under the old rules, the current model, those gains had to be deferred and amortized over the lease term. Under the new standard, those gains will be recognized up front, which is a positive for the lessees. So we may actually see more companies looking for sell-leaseback transactions, but that's helpful. All right, so let's think forward for a few minutes here about implementation considerations. We think it's critical for both lessees and lessors to start now to develop a plan for implementation. I mean, obviously, public companies have another year before they have to adopt. Private companies still have 2 years. But especially if you end up needing to make system changes, or if it's going to change some of your lease negotiating strategies, we think you really need to start now, at least understanding the standard, understanding where it might impact you, and then making decisions. Internal controls around how you negotiate leases, how you account for leases becomes important. In particular, if you have metrics that are tied to balance sheet metrics from a lessee perspective, or EBITDA metrics to the extent your classification changes based on changes in negotiating strategy. Obviously, you want to get ahead of that. It's never fun to have to renegotiate your debt covenant, but to the extent you can do that from a position of strength, that you're in good shape today, minor changes or known changes, not changes in the business, just changes driven by accounting. That is an easier conversation to have and always easier to do in advance rather than at the last minute. Obviously, to the extent you are public or you have investors that receive information on a regular basis, thinking about those internal and external communications. How do you explain to your stakeholders the changes that might happen either on your balance sheet or income statement, or again in lease negotiations? How your buy versus lease decisions might be fluid, might be changing with this new structure. And obviously, taxes, Richard mentioned the potential, at least, tax reform. But even absent that, to the extent lessees have leases that now go on the balance sheet, that's different than the current tax treatment. And so just thinking through what that might mean, maybe not much from a tax return perspective, but from a provision perspective and accounting for taxes, that may mean some complexity there. Richard, any other implementation considerations maybe that I haven't touched on, or other thoughts around what companies should be doing now?
Well, and I know we're going to have a lot of questions. I've been watching them as you've been talking on the bottom left. If I go back to the effect on the lessees and the lessors, and I don't know how this ties in with implementation, but for somebody like Starbucks, who you cited above, did they not have a lot of their leases classified as as capital leases? And so I think we all thought, going back 4 and 5 years ago, that when the conversion of all these leases, potentially from operating leases to capital leases, or what we're now calling finance leases, were to occur, that we thought there'd be sort of this massive change in companies changing to shorter-term leases as a way to sort of limit the amount of liability on the balance sheet. But it's a rambling question, but is there not more concern or fretting coming to these companies about the impact on the balance sheet of all these leases?
Yeah, I think the short answer is yes and no. Most lessors, and Starbucks included, have very few, most lessees, Starbucks included, have very few capital leases. There is, I can't even say a cottage industry. I think there's a large industry of real estate lawyers who have done just a fantastic job historically of helping lessees negotiate leases to get to a point where they get the term that they need from a business and an economic perspective, but they just skirt the 75% test and the 90% test. And so, that's very common to see large lessees with very few capital leases on their books. Starbucks in particular, because so many of their locations are in line, right? They're in a shopping center. They're not standalone locations. But I earlier in my career worked for a restaurant company that had over 300 leases of standalone buildings, and I think we had 2 capital leases out of the 300. So that's actually really common to have companies who are large lessees but have very few capital leases. And so the short answer to the second half of your question is yes, they are very concerned about the impact this will have to their balance sheet. I think the good news is that this standard, these changes have been a long time in coming. I think the first exposure draft that the FASB issued, I believe, was back in 2013 or 2012. And it evolved several times before they issued the final standard in early 16. But this is at least something that most larger lessees have been thinking about for quite some time, and talking to their lenders, talking to their investors, talking to their audit committees to make sure that those stakeholders understand that this is coming. But I do think, for example, with Starbucks, it is absolutely possible, and I have no inside knowledge or know what exactly their financials look like, but I would suspect that this could literally double their balance sheet.
And I think that's sort of the, when I say the concern, in fact, I see Sharon, not to give you preference, Sharon, typed in a question here, what effect does it have on the triple net investment side? And I think she means on the investor side. So if the whole world, Starbucks included, tries to do shorter leases, since they're all going to have to carry this on their balance sheet, isn't it something where they're going to try and find ways to work to a new, shorter, less negative impact on the balance sheet? And therefore, if I'm on the investor side, maybe I was looking at a 20-year lease with Boeing Airlines, and now maybe they try and do a 10-year lease. Do you see that happening?
I do, although I think it's interesting because I think you're going to see sort of two ends of the spectrum, Richard, to be honest with you. So I think you've got some leases that are for things like warehouse space that's not instrumental to the business, right? It's not critical to the business model. And for that type of a space, I think lessees may start leaning more towards shorter terms to try to limit that impact to the balance sheet. On the other end of the spectrum, though, you have commercial leases that are critical to the business. I'll go back to my restaurant example, right? You don't want to move a restaurant every 5 years. That would just kill your business model. And so when you think about situations like that, I actually think what you might see in those types of scenarios are lessees actually looking for a slightly longer lease term in order to get that finance lease treatment. So, for example, if you're already entering into a lease that is, let's just say it's 85%, but the present value of the lease payments are 85% of the fair value of the building, right? So maybe it's a 20-year lease and with a relatively robust lease payments. Today, in today's GAAP, that's not 90%, and therefore it's an operating lease. So it's not on your balance sheet at all, right? But tomorrow, under the new standards, that would go on the balance sheet. So you would have a right of use asset and a lease liability that represent 85% of the fair value of that asset, right, the building. However, and so that's going to be treated as an operating lease, which means all of those rent payments will run through operating expense in the lessee's financials. If, on the other hand, they add, say, 5 years to the term and it pushes them to maybe it's 92% of the fair value, right? The impact to the balance sheet of a right of use asset and a lease liability that equal 85% of the fair value compared to one that equals 92% of the fair value, really not significant. There's really not much of a difference in the impact to the balance sheet. However, by flipping into finance lease treatment, all of a sudden now they don't have any operating expense. The rent payments turn into amortization of the right of use asset and interest on the lease liability, as opposed to an operating rental expense. And so that gives them a preferential treatment from an EBITDA perspective. It makes EBITDA look a whole lot better because all of a sudden you've lost an operating expense. And so we think that companies that lean towards those longer-term leases anyway for economic business purposes, they may at least start thinking about actually going the opposite direction and moving into a slightly even longer lease in order to get that preferential finance lease treatment. Other end of the spectrum, though, warehouse, office space, things that aren't critical to the business, things that you can move from pretty easily, I think there is that risk that people start to try to negotiate shorter lease terms.
And to draw an analogy that probably everyone in our audience from CCIM world would relate to is, the person that does a deal chasing a 1031 and they do a bad deal or a worse deal than if it was just a straight cash world deal. So we talk in this class about the cash world or the real world, the tax world and the accounting world, and how the accounting world and the tax world impact decisions. But I think that was a great answer that, a restaurant still wants a long-term secured lease for the primary reason of what their business is. If it's a good operating store, they want to keep it, right?
Absolutely.
So, yes, this will have an impact, but I'm also hearing, and I'm dumbing this down for people like me, but perhaps the trade-off here is while it might have a negative impact on the balance sheet, showing a liability of a long-term lease that didn't have to be recognized, if I'm hearing you correctly, perhaps there's the positives on the P&L side in terms of EBITDA.
That's correct. If you get into that finance lease treatment, there are some positives on the P&L side. And that's the case today with capital leases, right, that they have a better P&L impact. It's just that the balance sheet presentation for capital leases today is so much greater than the operating lease presentation that people are much more interested in getting the right balance sheet answer than the P&L.
And I know we've got about 7 minutes here, and I think I've got maybe 4 questions captured, so I don't know if you want to go through your last resource screen and then do the Q&A, Angela, or how you want to do this.
Sure. I'll just pull the resources screen up. I believe these slides are going to be made available to the participants, and I've got the full link there if you want to jot it down. But these are just some other, if you are an accountant or you've got accountants that you want to take a closer look at this, here are a few more items that provide some more information. The first one, there's a picture of it there. That's our newsletter. It's about, I think, 30-plus pages long. It obviously goes into a lot more detail on the new standard and the impacts. I will tell you that the other large public accounting firms, in particular the Big Four, have all issued very large lease books. I think KPMG's is almost 800 pages long. I wouldn't recommend trying to tackle that one up front. I'd start with our 30-page one and then maybe figure out what more you want to look at. I think ours is a good intro. There's also a webinar, again, if you want to go into more detail on both lessee and lessor provisions. That's available on our website as well. So just a few resources in addition if folks are interested in learning more about the new standard.
Well, if you want, I'll wrap into some of the questions I saw, and if anybody has one, type it in quick, and I'll see if we can get to it. I know somebody asked about what the effect of all of this or any of this is on nonprofit companies.
Sure. So nonprofits are not scoped out of the new standard, so they are scoped in. So all of this, everything we've been talking about today does apply to nonprofits. They're just, most nonprofits are considered private companies. You do have occasionally some nonprofits that issue certain types of bonds that cause them to be considered public, but I would guess that most nonprofits that are in that boat know they're in that boat. The one thing I will mention, I didn't have it on any of the slides, is that under current guidance today, if you have a related party lease, which often happens with nonprofits, the current guidance forces you to look through that related party lease and account for it based on its underlying economics, so more of a market approach. The new leasing standard actually does away with that, and it said, you know, it doesn't really matter. We're just going to follow the terms of the contract. So I think from a nonprofit perspective, that might actually be a benefit or a pleasant side effect, is that they no longer have to go back and sort of peek beneath the covers to try to figure out what the economics might be. They can, on a go-forward basis, just account for those leases based on their contractual terms. But other than that, again, nonprofits apply the standard just like everybody else.
And let me see if I can take this question if I'm paraphrasing, and sorry I didn't write down who asked it, but most of the people on this call are in the brokerage transaction-related world, so obviously you have incredible insight and incredible detail here. How do we maybe make this at a high level applicable for, if I said a street broker or somebody who does deal with obviously users and would have people that this would impact their financials? How do you see all this affecting the real estate world? I know it's a broad question, but any high level?
Yeah, I think the important point is probably just to have a high level understanding, and I'll back up a slide if you'll let me. And that last resource that I've listed there is really just about a 3 or 4 page summary of the new standard that was issued right after it came out. And that might be a good summary for someone like that. It's obviously not technical in nature. It just gives a high-level summary of the changes. And I think that really helps someone who's not an accountant, who really just wants to understand the basics of how this might impact them. But I think the most important thing for that group is probably just understanding what the pressures are for their clients, for the lessees, so that if their clients start coming to them with different negotiating strategies, they have an understanding of why.
And we have a broker-specific question that I like, and I think my answer, not answering it, but is there a difference in the tax world versus accounting world here? But the question was something about broker fees if they're not considered a direct cost, and I don't know if I captured all this. Will lessors just expense them up front?
Yes, that's actually correct. So anything that is paid associated with entering into the lease, setting the lessee up in the system, the advertising costs to find somebody, any of those costs that don't meet the definition of an initial direct cost, they just get expensed as incurred. Again, most broker fees are tied to the execution of the lease, and so I would expect that most of them would meet the definition of an initial direct cost. But if, for example, you've got a broker on retainer and you just pay them a flat fee because you do so much business that you just pay them, then yeah, that's something that wouldn't be dependent upon signing a lease, and so it would just get expensed as it's incurred.
And I guess my thought as it relates to tax world versus accounting world, in the tax world that may be a good thing in the sense that, quote, I write it off, I don't pay income tax on that amount. But in the accounting world, it shows up if you're expensing it, it really negatively affects your net income to the company, correct?
That's correct.
Right. So just a word in terms of just right there for everyone on the call, the difference in the accounting world and the tax world, sometimes they line up and if it's good for one, it's good for the other. Sometimes, like in this case, maybe they're opposite. So
Right.
Fabio had a question as much as a statement about are there examples that we have for that we could summarize for maybe the brokerage world, not the accounting world. I'll answer it saying that I know we have an activity in our new 104. I'll talk to staff about if there's a way to parse that activity out for some of our designees. And we talked, by the way, we didn't get too much into it today, Angela, on the different ratios of let's see if I can get them all down. Obviously, debt-to-equity ratio is one. A lot of us know current ratios and quick ratios. Does that mean anything?
Yes.
What does that mean to us?
Well, I think for all of those, well, those two ratios in particular, and debt equity included, are all balance sheet metrics. And so for lessors, there's probably not much of a difference, right? Because your balance sheet shouldn't change significantly with the new standard. But the companies that are impacted that really need to start thinking about those metrics are the lessees.
Well, good. I don't know if the CCIM staff wants me to stop. It's 5:01, and I know we're trying to get everybody out here in an hour. So chime in, or do we have questions, Jennifer? I see one more here. I got to read it, though.
Yeah, Richard, why don't you take that last question because it may be of interest to several, and then we can wrap up.
And so, Angela, without me reading it, I don't know if you see Joseph's question in the bottom left. I think that's hopefully about the last one I didn't get. Something about regard to small business owners who presently lease their business space based on these new accounting rules. Does it seem more feasible for a small business owner to own versus lease? And that really, to me, seems like one of the big questions for our industry is how this might affect lease versus own.
Yeah, and I think that's an excellent question. I really think it will be entity specific. And because I really think that most companies, especially small businesses, their primary motivation in entering into leases is probably not to get off balance sheet treatment. Because a small business is really not usually, they usually have a founder, a single person or family that owns them. They're usually not so worried about their balance sheet presentation. They're more worried about cash flow and other risks. And so I don't really think this will significantly change their own versus buy decision. But some larger companies that do care about balance sheet presentation and that have easy access to cash, that I think it could change their decision.
Well, great. I think I'm done asking questions since we're past the hour mark. And Jennifer or anyone at CCIM, you want to wrap this up for us?
Yes, Richard and Angela, thank you so much for your time and expertise this afternoon. We appreciate it. And to our audience members, thank you. Within the next 48 hours, you will receive a follow-up email with a link to today's webinar recording. Additionally, the slide deck is available for download using the course site, which you received prior to today's course. Again, thank you to all that participated, and have a wonderful week.
Thanks,
guys. Thanks, Angela.
Thanks, Richard.